If this was a test, an examination, how much can a wrong answer cost you? $100? Or how about $100,000, which is quite a lot, isn't it? But what if it was $100 billion? Yes, you heard it right. $100 billion, because that's what Alphabet lost in market value when its AI chatbot Bard gave an incorrect answer at an event earlier this year. Sounds a bit crazy, doesn't it? Well, maybe not if you are a part of the Adani group who lost over $100 billion because of a report, and for companies like Meta, Snap, Twitter, and Pinterest that saw an impairment of over $300 billion in market value on account of Apple's iOS privacy changes. The point is, these companies displayed fragility, which is a term that explains how vulnerable a company or a system is to external shocks and stressors. Now, from an investor's point of view, we can only measure fragility in our portfolio, but we can never forecast when an adverse event is likely to occur. I mean, we've seen the impact of COVID, the Ukraine-Russia conflict, the impact of chip shortages, and even geopolitics when our own government banned palm oil exports from Malaysia because the then Prime Minister made some politically insinuating statements. We investors don't control any of this, but what we can do is to keep fragility at such low levels that an adverse event has a minimal impact on a portfolio, and that's what this video is all about. Now, there are many fragile and robust businesses out there, and one of the ways of characterizing it is by examining the optionality factor. For instance, a fragile business is one which has more obligations than options. And a good example of that is the airline industry or even the sugar industry, where in a video I explained how a sugar mill has no control over the raw materials. It cannot fix the price of sugarcane. The mill has no say on how much sugar it can produce and at what price it can sell in the open market. In fact, my YouTube channel here itself is a little fragile because its growth depends heavily on the YouTube algorithm, and unless I expand my revenue streams beyond advertising, there's always that chance of me shutting shop due to negative cash flows. Now, an anti-fragile, robust business is exactly the opposite, and it has the flexibility to choose amongst different alternatives in an uncertain situation. In other words, it has more options than obligations. In fact, some characteristics that have come to define an anti-fragile business includes a strong brand or competitive advantage that appeals to consumers, so a brand like Apple, Amazon, or Amul. A diverse portfolio of products, services, markets, and customers that reduces dependency on a single source of revenue or demand, and my YouTube quandary is a good example of that. It also fosters a culture of innovation, improvement, and creativity, like what an Alphabet, Amazon, or Alibaba does, and I'm not sure why all these companies are starting with the letter A. Anyways, number 4, robust businesses have flexible org structures which improves and accelerates decision making. And of course, these businesses have a high degree of optionality, a multitude of choices that allows them to exploit opportunities and avoid risks at most times. Now, discovering an anti-fragile company is extremely difficult, which is why we'll take the other approach and figure out how one can avoid investing in the fragile ones. So, as per the research available on Budget Tiger, there are 4 financial metrics that can help us identify fragile companies, and you can use any standard screener to work this out. The first of the 4 metrics is equity as a percentage of total liabilities. Now, in any standard balance sheet, we have the assets on one side and we have the liabilities on the other. And what's interesting is that the equity, that is the equity share capital and the reserves and surplus, are also listed under liabilities. However, equity is a type of liability which the company is not obliged to pay up, and the rest, the long-term loans, accounts payable, taxes, etc., everything else needs to be paid back within a stipulated period except equity. So the way to read this information is that higher this equity to total liabilities ratio, less is the obligation for the company, and therefore lower is the level of fragility. To explain this better, I'll be referring to a couple of stocks, Larsen & Toubro, which is in the large cap space, and also Sun TV Network, which is a small cap company. Now, in the case of Larsen & Toubro, the equity part comes to a little over 89,000 crores, while the total liabilities are 3,30,000 crores. This gives us an equity to total liabilities percentage of 27%, which is not a strong number, and on this point, L&T is definitely fragile. In fact, we can see this over many years, and this number continues to be in the 23 to 27% range, which doesn't inspire much confidence. On the other hand, Sun TV is a lot more robust with a very high equity to total liabilities ratio that has consistently been above the 85% mark. The next ratio is break-even sales as a percentage of actual sales, and this ratio reveals the proportion of sales that's required to cover a company's fixed plus variable cost. Let me explain this. So the expenses of a company can be bifurcated into fixed and variable. A variable expense is incurred when a sale is made, while a fixed expense is like an obligation that needs to be incurred whether the sale happens or not. In other words, higher the fixed expenses, more are the obligations, and therefore greater is the fragility within the company. Now, fixed expenses divided by the variable margin gives us the break-even sales. On a screener, this can be achieved by using the interest plus depreciation in the numerator and then dividing it by the operating profit margin. This is a bit of an oversimplification, but as per Mr. Vinakota's research, this broad formula should generally suffice. So in the case of Larsen & Toubro for FY23, the summation of interest and depreciation comes to 12,700 crores. Dividing this by the 15% EBITDA margin gives us the break-even sales, which is a little under 85,000 crores. This puts the break-even sales at about half the actuals, and this has been the case for many years. It's definitely not a sign of strength, which is another way of saying that the company is fragile on this particular counter. On the other hand, Sun TV Network has been consistently bringing down this number, which means it has a lot more flexibility, more options on how it can manage its business, which definitely indicates financial robustness. The third metric of importance is the return on capital employed, and this is something we have examined in many of my previous videos. So the ROCE is a profitability metric that explains how efficiently or inefficiently a company is using its capital to generate returns. A high ROCE number is highly desirable as it also indicates some inherent strengths in the company's business model that allows it to generate superior returns. Now for Larsen & Toubro, it's been a consistent 11-12% over the years, and from what we have learned in other videos, this number is not sufficient. On the other hand, Sun TV has always clocked 25% or more, although I must say the ROCE has been declining over the years, and it's something that has affected the company's stock price as well. But as a thumb rule, a high ROCE indicates that the company is not fragile. And the fourth and final metric of significance is the cash flow from operations as a multiplier of yearly debt obligations plus replacement capex. This line is quite a mouthful, so let me break it down for you. So the first part of the denominator, that is yearly debt obligation, is a summation of two things. The first is the interest that needs to be paid on the company's borrowings, and this number can be easily obtained from the profit and loss statement. The second obligation is the installment that is payable on the principal, and a crude way of arriving at it is to take 20% of the long-term borrowings, which obviously assumes that the loan needs to be paid off in 5 years. In the case of L&T, the long-term borrowings are 1,20,000 crores for FY23, and 20% of that comes to 24,000 crores. When we add the interest to it, we get an yearly obligation of 33,300 crores. Now we also need to add the replacement capex, and an acceptable proxy for that is the depreciation number. So this adds an additional 3,500 crores to the numerator, and we are now at 36,800 crores. And the last step is to measure this number against the company's operating cash flows, which in L&T's case comes to 0.6 in FY23, and in some years it's even negative on account of an unhealthy cash from operations number. To put this in words, a lower multiplier represents a higher level of obligation and therefore a greater fragility score, which is exactly where we find L&T at. On the other hand, Sun TV Network sits pretty at 4.1 times, and that's a number that has pleasantly come up over the years. To put 4.1 differently, it's like saying the company Sun TV can utilize 75% of its operating cash flow to other purposes like increasing capacity, paying a dividend, share buyback, acquisitions, etc. and can do this freely because there is enough money to cover the obligations part. So the four metrics we have discussed so far all come together to form what is called a Fragility Scorecard. To put it simply, this scorecard gives us a single view of a company's financial health, that is how fragile or how robust a company really is. The process starts with the shortlisting of companies. The idea here is to build a large universe of companies with over 100 crores of market cap, and this comes to 2,100 of them. The next step is to sort these companies into 10 equal parts or deciles. And in other words, we have to now calculate the 10th, 20th, 30th, 40, 50, 60, 70, 80 and the 90th percentile for each of the 4 key financial ratios. For example, the first metric, that is equity as a percentage of total liabilities, would show up a bit like this in the table here. So the 10th percentile includes companies with the weakest numbers, and this comes to 22.6%. And as we go down the table, we start getting into companies that have a more favorable ratio. We conduct the same process for the other 3 metrics, and although these numbers will change every year, here's how it entirely looks. So understandably, the more fragile companies are ones where the equity as a percentage of total liabilities is low, break-even sales as a percentage of actual sales is high, the return on capital employed is low, and where the cash flow from operations as a multiple of yearly debt obligations plus replacement capex is also low. Now, once these numbers are ready, the next step is to plot these decile numbers on a standard graph. As one can see here, we have the percentages to the left, the multiplier to the right, whereas the x-axis marks the percentiles. Now let's take our first company, Larsen & Toubro, and plot the values on this fragility scorecard. There we go. So in a single glance, we can see the fragility levels of L&T, and it's easy to interpret that the company is quite fragile. In fact, if you see a lot of dots on the left side of the graph, then it shows that the company's financial position is pretty shaky, while dots on the right side of the graph indicates the exact opposite and conveys robust financial health. I mean, look at Sun TV Network in that regards, and this fragility scorecard clearly shows that the company is in good financial shape. Now, I can do this exercise on a range of companies, and to give you a small head start, I am enclosing a worksheet which includes the values against each of the 4 metrics for some of the more popular companies in India. So to sum up this video, we now have something new in our investing toolkit, a fragility scorecard, and I'm hopeful that going forward, for every company you analyze, you will ask yourself these 4, 5, 6 questions which will help you better identify the inherent financial health of those companies. Once again, I thank you for your time. I sincerely hope you found this video informative, and if you have friends or colleagues who might find use for it in their own investing journey, then do share it with them. Keep learning, keep earning, and I'll see you next week. Until then.